Thanks for staying with us on the news at 1. Let's take a look at your market news now. Asian shares were mostly lower today. This was despite technology stocks being bolstered by solid earnings from US stalwarts and on strong pre-orders for Apple's iPhone 10. Oil hovered around a 2-year peak on concerns of tightening supplies. Japan's Nikkei made little headway in choppy trade, with gains in suppliers to Apple offset by selling in financials and caution ahead of major central bank meetings this week. The Nikkei ended flat after hitting a fresh 21-year high in early trade. Hong Kong shares fell with sentiment hurt by a slump in mainland stocks that was triggered by liquidity concerns. The Hang Seng Index lost 0.4%. Shanghai stocks posted their biggest one-day slide in 11 weeks, dented by expectations of a new wave of initial public offerings and a further rise in bond yields, signaling tighter liquidity. The Shanghai Composite Index dropped by 0.8%. Wall Street climbed on Friday as a surge in the tech sector and a rally in Amazon shares helped push the Nasdaq to its best day in nearly a year. Amazon's shares were up by 13.2% after it reported a quarterly sales surge. The Dow Jones Industrial Average rose by 0.1%. The S&P 500 gained 0.8% and the Nasdaq Composite Index added 2.2%. Now for more of the markets, we cross over to the Johannesburg Stock Exchange. Nompumelelo Siziba is standing by there. Good afternoon, Nompumelelo. Over to you.
Thanks very much, Nzinga. Well, global markets will be keenly watching what happens later in the week from key monetary policy makers, namely the Bank of Japan, Bank of England and the US Fed. The US Fed tends to be more important, if you like, because it represents the largest economy on the globe. The expectation being that rates will not be raised this month. Markets still expecting that they will raise rates in December. They'll be looking at the tone of the statement that's going to be put out later in the week to see whether they're still seemingly hawkish. So that's number one. And if they are, that's generally negative for emerging markets. But chances are that if rates do go up, that's already priced in generally into emerging market currencies. The local currency are still very much on the back foot. This follows obviously last week's midterm budget. It's just really struggled to recover, although it's not at the lows that it hit immediately after the midterm budget. Not looking good. And also bond yields still very high. That is the interest rate that investors demand that South Africa pay in order to be able to sell their bonds, which is ultimately a loan. So that's not looking good as well. Let's take a look at the indicators. Well, I'm joined by Gary Boyson. He's from Rand Swiss. Thanks for joining us, sir.
Yeah, thanks for having me.
Good stuff. We're seeing a bit of a mix in markets today, but generally speaking, we have been seeing global markets surging ahead. Do you think that this is going to continue, and if so, why?
I hope it's going to continue, but you know, they say no one can predict the next market crash. It's going to be one of those you know, unknown unknowns. So something will happen eventually. We probably will crash, but I mean, how can I tell? Looking at the data, though, I mean, I think a lot of people have been concerned about the US markets being a little bit overheated. It's obviously been on a very, very strong run. And we're kind of in the midst of US earnings season at the moment. And people were concerned that perhaps the earnings weren't going to quite match the expectations. That said, we had Amazon out on Friday, 13% jump on the stock price on much, much stronger numbers. Google and Microsoft also came out, so the big, heavy tech giants, really proving that they deserve their valuations. So, you know, from here, it looks like onwards and upwards. We're also conscious focus on the US. You look at the Indian stock market as well. That's also hitting record highs. And Asia pretty strong as well, with the Nikkei also doing exceptionally well. So, yeah, it's a very benign place for markets to be, I suppose.
And we also see that US GDP rose by 3% in the third quarter. That was way higher than expected. They expected 2.6%. So fundamentally, that place is looking quite good.
Yeah, the US is looking absolutely brilliant. I mean, you're getting the economic growth coming down. You've got labour markets pretty much at frictional unemployment. And now, we still have very loose monetary policy as well. So, I mean, we're expecting the Fed to keep on tightening, but given the real economic situation on the ground, it's starting to look like they should have been doing it a while ago.
And then the oil price, we see that reached a 2-year high. This on the back of comments made by the Saudi Crown Prince that he's very keen for that output cut situation to continue or to be extended further. We know that they're going to do it until about September 2018 or so. So do you think that this is working towards balancing the market, or you always got the threat of the US riggers coming in and basically, putting more supply into the system?
Sure. So looking at it, it's interesting. So, when we got the big drop-off in oil prices, it was Saudi Arabia that was coming out and saying, well, let the markets determine the price. We're not going to we're not going to fix, we're not going to try and balance the market. And now I think they're seeing that they're going to have to, because as you said, the US shale drillers are, they're making it an exceptionally competitive marketplace. And, from the latest reports are now starting to export and take market share in Asia as well. So, it's not just Saudi Arabia that's voiced, I suppose, support of extending those cuts for longer. It's also Russia, which is a major producer. But certainly, I mean, very interesting dynamics in the oil market from a geopolitical point of view, with Donald Trump also, really casting the focus back on the Iranian sanctions as well, and whether Iran is going to be able to find markets to sell its oil overseas.
But in terms of the oil price, do you think that we're going to have to live with this sort of $60 a barrel level and basically continue to experience high inflation? Because we haven't really seen a petrol or a fuel cut in a while.
I don't know if we're living with 60. It's nicer when it was 30, but certainly at least it's not $100 a barrel anymore. Looking at it, it seems just from kind of reading the flows in the market that futures and option positions are actually picking up on oil positions at the moment, which is kind of saying that the market and traders are expecting the oil markets to go higher from here. I suppose they're expecting those supply cuts to come through the oil market to balance nicely. But if the market can stabilize here, very good for inflation, because I think the risk certainly is that oil prices are significantly higher, and that they return to sort of a $70, $75 range. We
have other inflation risks, and that's namely a weaker rand, and that comes from obviously the midterm budget and other factors before. It was weakening even before that, but it got worse with that statement last week. And we see that our bond market also not doing terribly well. The yields are rising. If you could just explain to the viewer what that means exactly, and what do you foresee for our bond market and ultimately the rand?
Well, essentially, with yields rising, your bond prices are inverse to yield prices because of the way their coupons work. But essentially, if yields are rising, it means the price of your bonds is falling. It means people are selling off your bonds. Now, if you look at it, I mean, it's very interesting. Anyone that comes out with kind of a pro-South Africa stance at the moment gets shot down immediately, it seems, by investment banking clients. But certainly, I think there's a good argument to be made that, the markets have priced in, the poor economic outlook for South Africa, as well as the event risk around the December conference as well, as well as a rating downgrade. So what we look is what's called credit default swaps, which is your CDS rate. And now after our mini budget, we saw that push out to about 180 basis points. Now, what that means is that we're essentially at the moment not just pricing in a rating downgrade, because credit default swaps essentially insure the risk of a default in your bond market. Now, it's not just pricing in one ratings downgrade, it's actually pricing in 2 credit rating downgrades. Now that for me says that a lot of this is already in the financial markets, and that if we see anything optimistic coming out, we'll see a flood of foreign money coming back to South Africa, and the rand actually getting a little bit stronger. So for me, it just looks like you should be cautious. Things might be priced in, and just heading for the hills is probably not the right way to go.
All right, we're going to leave it there. We've run out of time. Thank you so much, Gary. That was Gary Boyson with his insights on market developments. After a short break, Nzinga has more business news for you.